Greetings, this is the practice questions on bonds and equities. So question 1, on 1st of October, a company issued some bonds with a face value of 500,000 104, interest were paid, blah, blah, blah. So this is simply going to be what is the issue of the bonds, and what this means is that we have 500,000 is a face value, 104 means 104% of face value, and so the cash that would be received on issuing these bonds would be 104% of 500,000, which is 520,000, and so the entry would be a debit to cash of 520,000. There'd be a credit to bonds payable, which is the face value of the bonds, 500,000, and then there'd be a credit to premium on bonds. And so which answer describes that? Is it interest, nothing to do with interest payable, a credit of 20,000 to premium? That sounds likely. Let's hope the others are wrong. No, we don't put the credit to bonds payable. We don't put a debit to bonds payable, so both of those are wrong. Though interestingly, international financial reporting standards say that you just put the credit of 520 to bonds payable, and it wouldn't surprise me if within a few years US GAAP moves in that direction as well. But at the moment, the bond payable carries the face value, and the premium or discount is what's called an adjunct account. Question 2. On January the 1st, a company sold some bonds, 12% is a coupon rate, face value of 600. The bonds mature in 5 years and the interest is to be paid semi-annually. The bonds were sold for this price. What's the total interest expense? So think about questions like this. Think about what interest is. Interest is simply the difference between the amount that you borrow and the amount that you pay back. Right? To the extent that you pay back more than you borrowed, it must be that there's interest. So rather than doing a great long amortization table and working out the interest expense recorded every year, we can say, well, how much was borrowed, how much was paid back? Well, the repayments are going to be the coupon over a number of years. So the repayments will be semi-annually, and so, though in fact we don't really need that, it's actually 5 years, so there's 10 payments, of each payment being 6%, because 12% a year is 6% every 6 months, multiplied by the face value of 600,000. So the total coupon is 360,000. The repayment of the principal at the end of the bond's life is the face value, which is 600,000. So the total repayments are 960,000, and if we compare that with the amount borrowed, which was 646,328, right, that's what the bonds were issued for, so that's sort of the amount borrowed on day one, and then the difference is 313,672, so that difference must be interest. The company borrowed about 650,000, they repaid 960, the difference is the interest expense over the period, and so the answer is C. Question 3. A company has bonds outstanding with a par value of 100,000. The unamortized premium on the bonds is 2,700, and if the company retired these bonds at a call price of 99, and that means 99% of face value, so in this case face value is 100,000, this is 99,000. What's the gain or loss on retirement? Easiest way to think about this is think of the fundamental balance sheet equation: assets equals liabilities plus stockholders' equity, and therefore change in assets equals change in liabilities plus change in stockholders' equity. So as a result of this redemption, we know that cash goes down by 99,000. Right, that's the amount paid to redeem the bonds. The liabilities goes down by whatever the book value of the bonds were, and so we know that the book value of the bonds is 100,000 for the face value, but also a further 2,700 for the premium on bonds, the unamortized premium on bonds. And so what we have is liabilities goes down by 102,700, cash goes down by 99,000, and so it must be that stockholders' equity goes up by the balancing figure, which must be 3,700. So in effect, there's a gain on redemption of the bonds. And so the gain or loss is a $3,700 gain. Question 4. If the bonds are issued at a discount, it means what? Well, we know that bonds issued at a discount just means that the coupon rate is less than the prevailing market rate of interest. So let's see which of these says that. Financial strength of the issuer, nothing to do with financial strength of the issuer. The market interest rate is higher than the contracted rate. That certainly sounds likely. Let's hope the other two are wrong. Market interest rate is lower. No, it's not. Then if the contracted rate is higher, or if the market interest rate is lower than the contracted rate, the bonds would have been issued at a premium. That's not that. The bondholder will effectively receive less interest than the no, it's nothing to do with that. And so there is indeed just one right answer, and it is B. Question 5. A company issues 150,000, so this is the face value of the bonds, 6% 5-year bonds on a certain date, but the bonds pay interest semi-annually. So we know we have to actually turn that into, from an annual interest rate, to say, well, you say 6%, but it's really 3% every 6 months. And you say it's a 5-year bond, but it's really a 10-period bond. The bonds are issued to yield 5%. Well, again, that's an annual interest rate, so we've got to say that really means a yield of 2.5% per 6-monthly period. And rounded to the nearest dollar, what are the proceeds from the bond issue? And we've got present value tables. So if we look at these, we've got the present value of the coupon payments. And so that's going to be a periodic payment of, we said, 150,000 multiplied by 3%, which is, so that's 4,500. And so the present value of this coupon is 4,500 per period, so multiplied by the annuity factor for 10 periods at a rate 2.5%. Remember, we always use the market yield in doing this, so that's 4,500 multiplied by, and we can use the discount factor. Did I put in 2.5%? Yes, I did, and we can see, let's make this a little bit bigger. So we can see that, whoops, the present value of an ordinary annuity is down here, 10 periods, so this is 8.75206, and in a minute we're going to use the discount factor, so let's look at 10 periods 2.5% for the discount factor. 10 periods 2.5% is 78,120. And so go back to the slide. So we said 4,500 multiplied by 8.75206. We've got the present value of the principal being repaid. And so that's 150,000 multiplied by the discount factor for 10 periods at 2.5%. So 150,000 multiplied by that. So that gives us, we've done this already somewhere, this amount is 117,180. The present value of the coupon is 39,384, and obviously we're only using tables accurate to 5 decimal places. And so if we add together the present value of the coupon payments plus the present value of the principal, that comes to 156,564. And so the answer is B. And in fact, if you use a spreadsheet and use a financial calculator, you should actually get the exact same answer, at least I do, even though we've only used figures here, tables here, which are accurate to 5 decimal places. Apparently that's enough in this case. Question 6 is similar, but there's an extra step. But initially we have to work out the issue price of the bond, because unless we know the issue price, we don't know what the amortization will look like. And so on July the 1st, a company issued 300,000 of 9% 10-year bonds. So again, let's look at the present value of the coupon. So the present value of the coupon is going to be the 300,000, again, pay interest semi-annually. So 9% per year is, of course, 4.5% every 6 months. So 300,000 multiplied by 4.5% gives us an annual rate of periodic payment of 13,500. It's 10 years, and so we know that's going to be 20 periods, and the market rate of interest is 8%, and so that implies 4% per period. And so the present value of the coupon is going to be the 13,500 multiplied by the annuity factor for 20 periods at a rate of, we said the market rate was 8% per year, so 4% per period. So that gives us 13,500 multiplied by, again, let's look at the tables. And we have, again, 20 periods. We want the 4%. The annuity factor is this number here, 16.35143, is it? Sorry, 4%. 4%, so 13.59033. So 13.59033, and while we've got the tables open, let's look at the discount factor, because we know in a second we're going to be using the discount factor for 20 periods at 4%, and we're going to use that to do the principal, but let's just write down the number while we're there. And so this is 20 years at 4%, 4.4639, so 0.45639. And so going back to what we've got written down here, the present value of the coupon's that. The present value of the principal is 300,000 multiplied by the discount factor, so 300,000 multiplied by this. So what we have is, I think I've done this already, 45639 times 300, so this number comes to 136,916. This calculation, 13,500 multiplied by 13.59033 comes to 183,469. Add those two elements together, and that gives us an issue price of 320,385. And so if you think of what happens in the bond amortization table, we start off with the issue price. We know that if you think about the amount that the company owes on this, well, the interest that accrues for the first period of 6 months, and how much is that? Well, we know it's 4% per period. And so if you like, think about this loan balance gets bigger by 4%. So 320,385 multiplied by 0.04 is 12815. And then there's a cash payment, which is the coupon, which is 13,500. Right, we know, of course, that's going to be more than the interest expense. That's why these bonds were issued at a premium, because the coupon rate of 9% was bigger than the market rate of 8%. And so what happens is this balance on the loan goes down over time, and do the calculation, and it comes to 319,701. And so the answer is just A. Question 7. This is a real pig, because you've actually got to do two calculations. First of all, you've got to work out the issue price, then you've got to work out the interest expense for the 2 periods. So this is a really long one. I can't imagine there'll be many like this. I would hope there isn't even one like this in the real quiz, but we'll see. So what's the issue price of the bonds? Again, 7% interest. Is it semi-annually? Yes, of course. So 7% is actually 3.5% per period. And I think I don't have tables to do 3.5%, do I? No, I don't. So I'm going to go straight to the calculation in the spreadsheet and work out what the issue price of the bonds is and what the interest is. So in effect, do the whole of the amortization table. And as I say, I strongly recommend you actually have an amortization to hand. And so let's go to that. So if we put in the numbers, and I know you can't see the question, but I hope you've got it in front of you. The face value of the bonds is, wrong table, the face value of these bonds is 400,000. The coupon rate on the bonds is 7%. There are 2 periods per year. The term of the bond in years is 5, so as before, 5 years. The market interest rate at the date of issue is 6%. And from that, we can see that the issue price is 417,060. So issue price is 417,060. And from the amortization table here, we can see that the interest expense is the sum of the interest payments just for these first 2 periods, for period 1 and period 2. And so interest expense in 2018, I'm just writing it down, is 12,512 plus 12,467. So interest expense 12,512 plus 12,467, and add those two together, and it comes to 24,979. And that's all we do, just add them together. The answer is C. Question 8. Lopez Plastics Company issued callable bonds with a par value of 200,000. The carrying value of the bonds on January 1st, 2015 is at this price. On the same day, the company calls the bonds and retire them. So this is just like the question we had earlier. Again, let's think about what happens to change in assets, because we know change in assets is change in liabilities plus change in stockholders' equity. So call the bond at 103 means 103% of the 200,000, 103% of the face value. And so these bonds are redeemed at or called in, and cash goes down by 206,000. Liabilities goes down by whatever the book value of the bonds was on that date. And so liabilities goes down by 203,717. And so assets has gone down by more than that, and so it must be that stockholders' equity goes down by the difference. So 206,000 less 203,717 means there's a loss on redemption of 2283. So it's a loss 2283. Question 9. A company had issued bonds in the past with a face value of 600,000 as a price that they'd given. During 3 years later, the company exercised a call provision and redeemed the bonds for 101. So that means 101% of face value. So that would be 606,000, right? Because we know the face value is 600,000. At the time of redemption, the bonds had a balance sheet value of 607,000, and that makes sense because we know that they were issued at 102, and so the issue price we don't actually need this for the question, but the issue price had been 612,000. Okay, and then what's happened that over the last few years, from the date of issue to 2015 when they were redeemed, they've been amortizing that premium. So what we care about is 607,000. What's a journal entry to record the bond? So again, remember, change in assets is change in liabilities plus change in stockholders' equity, and so the gain or loss on redemption is the difference between the change in cash and the change in liabilities. Well, we know that the cash goes down by 606,000. The liabilities goes down by whatever the book value of the bonds were at the time of redemption. So liabilities goes down by 607,000. And so if liabilities goes down by more than the cash, it must be there's an offsetting increase in stockholders' equity. And in effect, that is a gain on redemption. Right? They think about it. I mean, they had this liability of 607,000 and they made it go away for a price of only 606,000. Good news. So a gain on redemption of 1,000. Question 10. Brown Company prepared the following journal entry: debit bonds payable, debit premium on bonds payable, credit gain on bond retirement, and credit cash. So, which of the following statements is incorrect? Well, I guess they're going to ask us something about what's going on here. And clearly, if this is a debit to bonds payable and a debit to premium and a credit to cash, they're awfully, in fact they are, they tell us they're retiring the bonds. And what's happening, that they're retiring the bonds and the amount of cash they're paying is less than the book value. So cash paid, or cash paid to redeem, is less than book value at the time of redemption. So let's hope that one of the questions is that. So which of the following is incorrect? The book value of the bonds was less than the cash payment. I think we just said the book value was greater than that, so I think that's incorrect. We'll carry on. The increase in stockholders' equity equals a gain on the bond retirement. Well, that statement's true. The decrease in assets is less than the decrease in liabilities, and that must be true, right? Because we know that the decrease, let's put those together, let's say that comes to a total of 110, and the decrease in assets of cash is 105. So yeah, that's why we've got a $5 gain on redemption or on retirement. So that statement's true. The net cash flow from financing activities decreases by the cash payment, and again, that's true. So yes, indeed, there is only one incorrect answer, and it's A. Questions on Chapter 11, Stockholders' Equity. Which one of the following statements is true about cumulative preferred stock? Well, remember, cumulative preferred stock is where the preferred stock gets their dividend, well, all preferred stock, the preferred stock gets a dividend before the common stock, and if it's cumulative, then it means the backlog of unpaid dividends on the preferred stock has to be paid before the common stockholders get anything. So it allows preferred shareholders to receive dividends for years during which none were declared at a date in the future when the company next declares dividends. That certainly sounds true to me, so let's hope that the others are false. It guarantees that, no, it doesn't. There's no guarantee involved. It's certainly the case that the preferred shareholders will get their dividends before the common shareholders, but it may be that the company goes broke before anybody gets any dividend at all. So B is not true. It allows investors to exchange their preferred shares for common shares. No, it doesn't. That would be if they were convertible preferred stock, not cumulative preferred stock. And it allows investors to obtain a share of any special dividends declared, and again, that's not true. That would actually be something called participating preferred stock. So the only answer is A. Question 12. Roberto Corporation was organised on January the 1st, 2012. During the year, the company did various things, and the question is, what's the total shareholders' equity at the end of the year? And so the issue of common stock is clearly going to increase stockholders' equity by 70,000. The issue of common stock a little bit later at $8 per share is going to increase stockholders' equity by the amount of cash raised, 160,000. They reported a net income. We know that goes into retained earnings. So that's going to be an increase in stockholders' equity. We've done that. They paid cash dividends. That's obviously going to be a reduction in stockholders' equity, comes out of retained earnings. And then they also purchased shares of treasury stock at $10 each, so that's a total of 30,000. And the fact that it was out of those shares is irrelevant. That is going to go against stockholders' equity. If you think about it, just think fundamental balance sheet equation, assets equals liabilities plus stockholders' equity, then the purchase of treasury stock is that cash goes down by 30,000. There's obviously no change in liabilities, and so it must be that stockholders' equity goes down by 30,000. So it's this treasury stock. It's actually treasury stock going up, but treasury stock is a contra stockholders' equity account. So you do all these, and it comes to 250,000. So the answer is C. Question 13. Boyle's company has 50,000 shares of $10 par value common stock outstanding. During the year, the company declared a stock dividend. It was actually 10%, which seems surprisingly high to me, when the market price of the stock was $30 per share, and 4 months later, they declared a cash dividend. As a result of the two dividends declared, what is the impact on retained earnings? So the way we record stock dividends is the stock dividend, if it's so-called small, and small for accounting purposes means 25%, but in practice it's never more than 1 or 2%. So I say in accounting textbooks you might get them at 10%. In real life you don't get them more than 2 or 3%. But the stock dividend is recorded at the market value of the shares issued. Right, so in this case, what was that? Well, the 10% stock dividend means that we issue 10% of whatever the common stock is. So there were 50,000 shares outstanding, so 50,000 multiplied by 10% means the company issues 5,000 more shares. The market price of the stock per share at the time of issue was $30, and so that's going to be a hit to retained earnings of 150,000. Sometime later, they pay a cash dividend on the number of shares. Well, of course, after this stock dividend, there aren't 50,000 shares issued, there are 55,000 shares in issue, and so 55,000 shares each get a dividend of 50 cents, and so that's a further 27,500. And so in total, the impact of these dividends together on retained earnings is 177,500. Question 14. Mar Corporation declared a cash dividend on December 31, 2014, payable in January, after the end of the year. A journal entry for the dividend was not made in December 2014. Well, obviously it should have been. So what's the impact on retained earnings and ... Okay, so think about this. The entry that we should make, or the company should have made at the time the dividend is declared, is to debit retained earnings, right? Reduce retained earnings, and to credit dividend payable. Because what he's saying is this is important because the readers of the accounts need to know that there's going to be this payment of whatever it is that's being made in early January. So the fact that they didn't make this entry, retained earnings were overstated. Okay, so it's not that. Retained earnings were overstated and liabilities were understated. So retained earnings was overstated, liabilities were understated. So B looks to be the right answer. Just make sure the others are wrong. Retained earnings was overstated. No, yes it was, but cash, nothing to do with cash. Cash was perfectly fine, so it's not that. Retained earnings and liabilities were overstated. No, liabilities were overstated, but retained earnings, sorry, liabilities were understated, and so it's not that either. So the answer is B. Question 15. The company plans to issue a 10% stock dividend. In accounting for the transaction, what's going to occur to stockholders' equity? Well, remember what happens is that when we have a stock dividend, all we're doing is shuffling around funds within stockholders' equity. So there's going to be a debit to retained earnings based on the market value of the stock, and there's going to be a credit to common stock. And then it depends, well, do we mean common stock, or are we interested in par value, common stock at par, credit additional paid in capital in excess of par? And the fact that we see indeed they're talking about additional paid in capital, then they obviously do want us to worry about these two elements. And so we know there's going to be a credit to common stock at par, obviously based on the par value of the stock, and then there's a credit to additional paid in capital common stock for amount in excess of par, whatever that is. So the difference between the par value and the market value of the stock, which is likely substantial. So common stock increases by the total market value of the dividend. Well, the two together do, but I think they want, I say that the fact they mention APIC separately means we better worry about that. So it's not A. Common stock increases by the number of dividend shares multiplied by the par value per share. That's correct. And retained earnings decreases by the total market value of the dividend. That's correct. And they sort of didn't tell us that this is an extra third bit. So I think the answer is B. When we get to C, common stock increases by the number of dividend shares multiplied by the par value of shares. Well, if we mean that par, yes, it does. Retained earnings decreases by the same amount. No, it doesn't. Retained earnings decreases by the market value of the stock. Retained earnings decreases by the number of shares multiplied by the par. No, it doesn't. It decreases by the market value of the share. So it's not that one either. And so the only answer that's correct is B. Question 16. Ashley Corporation had the following class of stock. It had some 6% par value cumulative preferreds, and it had some common stock as well. No dividends had been paid in 2011 and 2012, but on December 2013, the company did pay a dividend of 200,000. And who gets what? Okay, so we know that of this 200,000, so first of all, there's going to be the backlog to the preferred, and then we'll see what's available for common. So, and maybe we can put in total as well. Maybe we need that, maybe we don't. So first of all, there's the backlog for 2011, and these preferred stock are 6% of the $100, so that's $6 per share, right? 6% of 100 multiplied by the 2,000 shares means that the total dividend payable to the preferred shareholders each year is 12,000 before the common stockholders get anything. And because they're cumulative, this is going to mount up. So there's 12,000 payable to the preferred shareholders for 2011. There's another 12,000 payable for 2012. There's another 12,000 payable for 2013. And it's only after that, when these preferred shareholders have had their 36,000, that anything is paid to the common stockholders. And so it must be 164 is left over for the common stockholders. So the preferreds get 36, commons get 164, which looks like answer B. Question 17. Company issued 4,000 shares of $5 par common stock for $30 per share. The company then purchased 1,200 shares as treasury stock, and then it reissued some at $34 per share. So we know that when a company buys shares and reissues them at a profit, well, which it did because it bought them at 32 and issued them again at 34, so that's nice, it made a profit of 2. It doesn't get to put that profit into net income and not even in retained earnings. It gets credited to this separate account, which is paid in capital treasury stock, which comes about through gains on treasury stocks. So it sold, purchased 1,200 shares and then sold 400 of them, and so this gain is 400 lots of 34 minus 32, right? So 800. So that's going to end up in treasury stock, and there'll be a balance left on treasury stock, which is equal to the number of shares that are still there. So it was 1,200 and they reissued 4 of them. So the balance left on treasury stock is 800 at whatever the cost was, 800 lots of $32. And 800 multiplied by 32 is 25,600. So 25,600 is the balance on treasury stock, 800 is the balance on, and of course this is a debit balance, 800 is the credit balance on paid in capital treasury stock. So what have we got? Which of the following is true? The treasury stock should have a balance of 25,600. That looks pretty true to me, so let's hope that the others are wrong. The company has a gain of $800, sort of, but should it appear on the income statement? Absolutely not. The treasury stock should have a balance of 24,800. No, shouldn't we just worked out that it's 25,600? And then, so it's not that. The company has a gain of 1,600. Oh, it doesn't have a gain of 1,600, and it certainly doesn't appear in the income statement. And so the only answer is indeed A. Question 18. Luther Inc. has 2,000 shares of 6% $50 par value cumulative preferred stock and blah, blah, blah. What's going on here? They want to know the dividends received by the common stockholders. So similar to the previous question, we've got to work out what backlog is available to the preferred stockholders, because we can see these are cumulative preferred shares. So 6% of a $50 par value means that this is a $3 per share, and there are 2,000 of them. So $3 per share multiplied by 2,000 is 6,000 each year to the preferreds. Okay. And they were outstanding at 11, they were outstanding at 10. The board of directors declared and paid a $5,000 dividend in 2010. Okay, but there's going to be a backlog. So we have, of that 5,000, that partially covers the 6,000 of the preferreds, but in 2010, there's this backlog left over of 1,000, the shortfall of the 6,000 that the preferred shareholders are entitled to, and less the 5,000 that they got. And then in 2011, there's obviously their current year entitlement of 6,000. So 7,000 goes to the preferred shareholders in 2011. And so of the balance then, because we know the total is 24,000, right, so this is the total dividend, 7,000 goes to the preferreds, and that leaves 17,000 for the common. And so the answer is A. Question 19. As a result of a stock split, what's the effect of that? Remember, a stock split is where a company simply says, well, we used to have shares with one par value, we're just going to increase the number of shares and decrease the par value of each of the shares. And there's actually no accounting entry at all, because let's say we used to have 500 shares at a par value of 1. If they do a 2-for-1 split, then maybe there'll be 1,000 shares at a par value of 50 cents. So the balance on common stock before the split is 500. The balance on common stock after the split is 1,000 at 50 cents, still 500. So an entry must be made showing the effect on stockholders' equity. Well, not really, because there is no effect, so it's not that. The market price of the outstanding stock will increase because a split is evidence of a profitable company. Not necessarily. Often the reason why companies do it is to indicate good times ahead, so it's often associated with increases in the stock price, but it's certainly not guaranteed. There's got to be a better answer than that. The par value of the stock is changed in the reverse proportion as a stock split, and that's true, right? We just saw that. We said you go from 500 to 1,000, then the par value goes in the other direction from $1 to 50 cents. And D, the stockholders have a proportionate share. No, they don't, absolutely not, because they just have the same proportion of a larger number of shares. So the answer is indeed C. Question 20. Assume the following shares outstanding. There's some preferred stock with dividends in arrears, they're cumulative again, and there's some common stock. Total dividends were 50,000. What's the dividend to the common stockholders? So again, what we've got to work out is what's the dividend attributable to the preferred stockholders each year. So again, 6% of $50 par value is $3 per share, and there are 1,000 of them. So $3 per share multiplied by 1,000 implies 3,000 each year to the preferreds. And if they're in arrears, then of course the arrears have to be settled before the common stockholders get anything. So these dividends are indeed in arrears for 2011, 2012, 2013. So that's 3 years. So 3 years at 3,000 per year is the arrears of 9,000. And then there's the preferred dividend in 2014, to which the preferred shareholders are entitled, which is 3,000. So that's 12,000 to the preferreds. We know again the total is 50,000. Right, so of that 50,000, 12,000 goes to the preferred. That leaves, what's that, 38,000 to the common stockholders. So the answer is B. And that's it.